Hey everyone, and welcome back to the channel. Today, we're diving into the fascinating world of financial gatekeepers, the companies that essentially build the roads and charge the tolls for global investing. We're talking about two giants, MSCI Incorporated and S&P Global Incorporated. Visual aid. Animated graphic of a toll booth with MSCI and S&P Global signs. On-screen text. MSCI Incorporated and S&P Global Incorporated. The financial toll booths. You might not know their names, but if you've ever invested in a mutual fund, bought an ETF, or even just read about the S&P 500, you've used their services. These companies provide the essential benchmarks, ratings, and data that guide trillions of dollars in capital every single day. They are foundational to how money moves around the world. So, let's break down what makes them tick, their differences, and what kind of investment opportunities they present right now. Section 1. MSCI Incorporated, the Global Index Architect. First up, MSCI. Think of them as the architects of global investment maps. Their main gig, making up most of their revenue and profits, is creating and licensing financial indices. Visual aid. World map graphic with MSCI World Index highlighted, then transitioning to an ESG logo. On-screen text. MSCI Incorporated Global Indices. ESG and Analytics. Ever heard of the MSCI World Index or the MSCI Emerging Markets Index? These are crucial benchmarks for investors worldwide. MSCI makes money in two main ways here: recurring subscriptions for their data and software, and critically, asset-based fees. This means they get a small percentage of the money invested in funds that track their indices, like mini ETFs. This is a brilliant business model because as more people invest passively, MSCI's revenue grows without proportional costs. Visual aid. Bar chart showing MSCI's revenue growth 2020 to 2025. On-screen text. MSCI revenue growth 2020 to 2025 plus 13.1% CAGR. They also have a fast-growing segment in sustainability and climate, providing ESG, that's environmental, social, and governance, ratings and tools. This is a huge deal for institutional investors, who are increasingly required to consider these factors. MSCI's business is characterized by really high profit margins, often over 50%, because they collect data once and sell it many times. It's incredibly capital light. Section 2. S&P Global Incorporated, the diversified information powerhouse. Next, we have S&P Global. While they do have a joint venture for indices, the S&P Dow Jones Indices, which includes the famous S&P 500, their core business is actually credit ratings. Visual aid. Graphic of a credit rating, AAA, BBB, etc., changing from red to green. On-screen text. S&P Global Incorporated Credit Ratings. S&P 500, diversified data. When a company or government wants to borrow money by issuing bonds, S&P Global assesses their creditworthiness and gives them a rating. This is often a regulatory requirement and creates a powerful moat around their business, basically, a competitive advantage that's tough to beat. Unlike MSCI's mostly subscription-based model, S&P Global's ratings business is more tied to how much new debt is being issued, making it a bit more cyclical. However, they also get recurring surveillance revenue for monitoring existing debt. Visual aid. Diagram showing S&P Global's diverse segments: ratings, market intelligence, indices, mobility, commodity insights. On-screen text. S&P Global. Broader diversification post-merger. S&P Global is also much more diversified, especially after its big merger with IHS Markit. They now offer data for everything from commodity markets to the automotive industry. This diversification provides a broader revenue base, even if it brings a bit more complexity, and sometimes lower margins than MSCI's hyper-focused index business. Section 3. Key differences and investment profiles. So, how do they compare? Visual aid. Split screen comparison. MSCI, left, versus S&P Global, right, with key metrics, on-screen text. Left, MSCI higher recurring revenue, 73%, superior margins, 56%, high dividend growth. Right, S&P Global more cyclical ratings, broader diversification, dividend king, 53 years. MSCI has a higher percentage of recurring subscription revenue, making its business model generally more resilient to short-term market ups and downs. S&P Global, while larger and more diversified, still has parts of its business tied to the health of debt markets, which can be cyclical. When it comes to margins, MSCI is a superstar, consistently hitting operating margins in the mid-50s%. S&P Global is also excellent, with adjusted operating margins around 50%, but it's a bit lower due to more labor-intensive segments. Both are fantastic dividend stocks, but they cater to different styles. S&P Global is a dividend king, having increased its dividend for an incredible 53 consecutive years. That's consistency you rarely see. MSCI, while not a king yet, has shown much faster dividend growth recently, reflecting its commitment to returning its strong cash flow to shareholders. Section 4. Risks and the Future. AI, ESG, and Private Markets. Looking ahead, both companies are investing heavily in ESG analytics, artificial intelligence, and opening up private markets data. Visual aid. Icons representing AI, ESG, and a lock symbol opening for private markets, on-screen text. Future growth. ESG, AI, private markets. MSCI was an early mover in ESG and continues to lead. S&P Global is also expanding here. AI is a big focus for both, but S&P Global recently announced an AI-first strategy with significant capital investments, causing a bit of a stock price dip due to concerns about short-term margin pressure. MSCI seems to be integrating AI more incrementally. Risks. MSCI is sensitive to global stock market volatility because of those asset-based fees. If the market dips, so does that revenue stream. S&P Global is more sensitive to debt issuance cycles. Both also face regulatory scrutiny because of their dominant positions and high fees. Section 5. Investment takeaways: growth versus value. So, which one is right for you right now? Visual aid. Two distinct paths. Growth, path leading to MSCI logo. Value/income, path leading to S&P Global logo, on-screen text. Your investment strategy. Growth or value/income? As of early 2026, S&P Global has seen a significant pullback in its stock price, largely due to that AI investment news. This has made it look like a potential value opportunity, trading at a discount compared to its historical averages in MSCI. If you're looking for a fortress business, extreme diversification, and a legendary dividend record at a potentially attractive price, S&P Global could be your pick. It's a dividend king at a multi-year valuation low. MSCI, on the other hand, remains a quality growth stock trading at a premium. It's ideal for investors who prioritize high-margin recurring revenue, superior growth in emerging sectors like ESG and private markets, and aggressive dividend increases. Its lean structure and dominant position make it a natural beneficiary of the long-term shift towards passive investing. Conclusion: ultimately, both MSCI and S&P Global are world-class companies, essential toll booth operators on the financial highways. They have strong competitive advantages, high profitability, and are poised to benefit from the continued evolution of global capital markets. Your choice depends on whether you lean towards a growth strategy with MSCI or a value and Income Strategy with S&P Global. Visual aid. Both company logos side by side with a final, Invest Smart, graphic, on-screen text, MSCI or S&P Global. Essential financial infrastructure. As always, do your own research and consider your investment goals. If you found this breakdown helpful, hit that like button, subscribe, and let me know in the comments which company you find more compelling. Thanks for watching.